Welcome to the Torch Academy. Today, we're covering how to clean up your financials so your numbers tell a clear, compelling story to buyers. Welcome. So, here's the truth. A buyer is essentially paying based on your financial statements. They can't verify everything, so they trust the numbers on paper. If those numbers look messy or suspicious, they assume the worst: hidden liabilities, inflated revenue, whatever. Clean financials aren't just nice to have, they're critical to your sale price. In this video, we're going to talk about what clean means and what buyers are looking for. Buyers need three core documents. First, a clean P&L or income statement showing your revenue, your expenses broken down by category, and your profit. Ideally, 3 years of historical P&Ls so they can see trends. Second, a balance sheet showing your assets, equipment, inventory, accounts receivable, and your liabilities, loans, payables, debt. Third, your actual tax returns for the past 3 years. This proves the numbers are real. You filed them with the IRS. That gives them credibility. Here are the 5 steps to cleaning up your financials. Step 1, audit your records. Go through your transactions, your categorizations, make sure everything is accurate. Step 2, align your P&L to your tax returns. The income you show a buyer needs to match what you actually reported to the IRS. If it doesn't, red flag. Step 3, adjust for one-time items. If you had a big one-time expense or sale, separate it out. Buyers want to see the recurring earnings power. Step 4, fix your balance sheet. Every asset, every liability needs to be there and valued correctly. And step 5, consider getting a CPA review. If accounting isn't your specialty, a CPA can add a lot of value and credibility to your financials. They catch things you might miss and give buyers extra confidence in the numbers. Here's what messy versus clean looks like. On the left, a messy P&L just lists revenue as sales with no breakdown. Expenses are lumped into other. Personal expenses are mixed in with business expenses. The numbers don't match what was filed with the IRS. There's no documentation. And you can't clearly calculate profit. A buyer sees this and either walks or deeply discounts the price. On the right, a clean P&L breaks revenue down by service type or product line. Expenses are categorized: payroll, rent, supplies, whatever. Personal items are removed. The numbers exactly match the tax returns. You have documentation organized and accessible. And profit, specifically EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is crystal clear. Buyers trust this. Here's a real example. Tom owned a manufacturing business that showed $500K in profit on his internal statements. But when his CPA reviewed everything, she found problems. There was $40K in personal expenses that Tom had paid out of his business account but never actually reimbursed. There was $35K from one-time equipment sales that inflated the revenue line, and the numbers didn't match what Tom actually filed with the IRS. When cleaned up, the real recurring profit was $425K. Now Tom was nervous. He thought cleaning this up would hurt him. But the opposite happened. Buyers trusted the cleaned up numbers more. Because the numbers were transparent and defensible, Tom actually negotiated a better deal. The lesson: clean financials beat inflated financials every time. So, should you hire a CPA or do it yourself? Hiring a CPA costs $2,000 to $5,000, but you get professional credibility, they catch issues you'd miss, you save your own time, and they prepare documents that buyers immediately trust. DIY means you save money and have full control, but you risk missing problems and buyers might be skeptical. If accounting isn't your strong suit, a CPA can add a lot of value and credibility. But if you're comfortable with financials and willing to put in the time, doing it yourself is a valid option too. Here's a critical red flag. Many small business owners minimize taxes by deducting personal expenses, vehicles, meals, office supplies, whatever. That's legal and smart for tax purposes. But when you sell, you need to explain the differences between your tax return and your business profit. Buyers need to understand that you're adding back personal expenses to calculate the real earnings power. If you can't explain the differences clearly, buyers assume you're trying to hide something. This is where a CPA can really add value if you're not confident handling the add backs yourself. Bottom line, your financials are the foundation of your sale price. Messy books create doubt, and doubt creates discounts. 2 years of clean, consistent, professionally prepared financial statements give buyers the confidence to pay what your business is actually worth. If accounting isn't your specialty, consider working with a CPA who understands business sales. They can add real credibility to your numbers. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.